Welcome, everyone, to Regatta Capital Group's Young Investors webinar. Happy Friday. It's great to see you. You're already well ahead of the curve if you're even here joining us and ready to learn about finances and money. And we are excited to have you here. We have a full agenda. My name is Spencer Kelly, co-founder of Regatta Capital Group. I have been a financial advisor for, I think, over 22 years, and I'm joined today by my colleagues here at Regatta Capital Group. I'll let you introduce yourselves.
Hi, I'm Lindsay Duranian. I am a financial advisor at Regatta Capital Group. I've been at Regatta about just over 6 years, but I've been in the industry for about 11 years. So a lot of experience here.
My name is Erica Jenkins. I'm a financial planner here at Regatta Capital Group. I'm also a certified public accountant. I started with Regatta 9 years ago, but my experience in the industry started in 2005, so 20 years.
Thank you, Erica.
And my name is Chloe Mithal. I'm a financial advisor and certified financial planner here at Regatta. I have been in the industry for a little over 7 years and with Regatta for 4.5 years. And I'm very passionate about the subjects we're about to dive into today.
Thank you. Really appreciate you being here. Thank you for being here. I want to dive in here first with why it matters and what matters most and the motivation that we think is so important when it comes to caring about your money. I know for me, when I think about why do I work hard, why is saving and investing important, what am I looking to accomplish? One thing, for example, that really matters to me is travel and time with my family. So to take the time to budget and allows me the freedom to then take a trip with family, and that's incredibly important to me. So I encourage you to have a pen and paper today and take notes and jot down ideas. And right now, think of a few reasons why this is important to you and what you're looking to get out of it. Lindsay?
Yeah, and I love to travel as well. And I think especially with kind of the age demographics that I think we're talking to today, for me, when I was in high school, I always wanted to go to that concert. And we'll dive in this a little bit later in the PowerPoint. But I always wanted to go to that concert or go on that trip or soccer trip or whatever it was. And, I didn't really understand where that money was coming from, or maybe we'd ask our parents or something. So I wanted to make it more about me. So it mattered to me to start to earn those dollars that I could spend on those things that I wanted to do. So, it's just so beneficial to start at your ages now so that, as you progress in life, you have that time and energy on your side now.
You're still going to concerts.
I'm still going to concerts, so.
Erica?
Well, I'm not going to concerts, but I think what matters to me is having the independence and the ability to do what I want, whether that's going to a concert, for me, like sending my kids to a good college, being able to travel as well. That's why I do these things. I want to be able to do what I want and know that I could actually do it.
Chloe, anything to add?
Yeah, I agree with everything that you all said. Those are all my motivating factors as well. I think it really comes down to having options. So when you save and put money away, you have options now to get better health care, pay for that expensive vet bill, go to that concert that you want to. So really, by being disciplined and saving that money, having options is what I like to draw from this.
Wonderful. So as we think through successful saving and investing, at the beginning here, it's defining what matters to you and why this is important to you. And then we're going to jump in here, understanding where you are today. And we'll walk through fundamentals, talk about investing, where to get credible financial advice as well is important. Yes, there is some good information on TikTok.
Spoiler alert.
Yeah.
It's from us.
Yeah, exactly. Where to get that credible advice. But make sure you're working with the right folks. Let's jump in. And one of the most important things when it comes to money and where to put your dollars is lining up the timeline with those dollars, making sure that your short-term money that you might need in the first 3 to 6 months, in the next 3 to 6 months, maybe something in the next couple of years is in short-term investments so that you know that money will be available, but you still want it in a place where it can grow a little bit. But then once you know you have dollars that are really for the long term, you want to put those dollars into long-term investments. So just a very important point that we wanted to touch upon here at the start. So Lindsay, I'm gonna pass it over to you.
Yeah.
And for me, one of the things I find most exciting working with younger investors is the time that they have on their side and how valuable that is if they take advantage of it.
I'm sure we have a little bit of a range of ages, but as this slide says, I mean, let's say you're 25, or even if you're 15, 16, 17, you have time on your side. So just a quick math problem here. If you started now, again, this is saying 25, and you put 5,000 every year, again, high number, it could be 1,000, it could be 500, but just to get the idea, if you just put that in every year until you're 35, so in this example, 10 years. So if you're 18 till you're 38, if you're 15 till you're 25, and then you just stop.
Never
add another dollar. Okay. So all you're doing is adding the same amount for 10 years and you stop.
And you never invest again? Never
invest again. It shows you that in this exact example, if you put 5,000 in for 10 years, that's 50,000. You could have 850,000 by the time you're 65.
With an 8% return.
Well, yeah, sorry, yeah. I should say there is an 8% return there, and we'll go into the investing part, but I mean, it's just pretty crazy to see the benefit of compounding interest.
And starting early.
So this slide basically shows you, well, okay, let's say you waited. So instead of starting now again, we'll use the 25 age, you waited until 35 and you did that same thing. You would have to basically save a lot more dollars just to get to that same point. So for example, here, your contribution, let's say you started at 35 and you continue to add up until 65. I mean, look how much less you would have saved.
Yeah.
Because you started 10 years later.
Yeah. You've saved 3 times as much, but you started 10 years later and you end up with less.
So you saved more, but you started later. And then here, same idea. Now, if you were to start at age 25 and continue to invest up until 65, so instead of stopping after 10 years, you continue to invest that same, let's say 5,000 a year, up 40 years. Look at, you would go from, if you stopped at 35, you'd have about 850 at that 8% growth rate.
Yep.
You'd have 1.5 million. So it's just showing you if you can continue that habit and start early, the numbers they prove itself.
I like to think of this as like the baseline worst case scenario. You can retire a millionaire. Like if you do nothing else other than just, and trust me, right now, 5,000 a year might be a lot. In time, it won't be, and these are numbers that will only increase, but this is such a good bar. It's just, if nothing else happens,
right,
there's a path to being a millionaire no matter what. Just the consistency and time.
And in our slide, it starts at 25. We may have some audience here that are younger than 25. So time is on your hands. So what's the saying? The best time to invest is 10 years ago. Someone showed me this when I was 25.
Yeah.
But start now.
Exactly.
It's never too late.
So another fun metric here is the rule of 72. So how long will it take for my money to double? So this is a little bit of a different math problem. That was the consistency of saving every month and every year. This is even a simpler, just kind of simple little math problem in terms of, all right, if I invest $1,000 or $10,000 right now, how long will it take for my money to invest or to double?
Well, what's the rate of return? So we'll look at the chart. So if the rule of 72 is you take 72 and you divide it by your annual return. So how much you made on it. So if you're very conservative and you earn 1%, it's going to take you 72 years to double that money. So to get that 10,000 to 20,000, who wants to wait 72 years? So if
I don't.
yeah, we don't want to wait for that. So this is kind of to show you, well, there are times when you can take a little risk and ideally you earn more than that 1%. So easy math, go to 4%. So if you took that same 10,000 and you made 4% on it, it would take you 18 years. Again, still doesn't sound that exciting to wait 18 years to double that 10,000. So that's where we'll get into a little bit further in the presentation. But, ideally, dollars that you're going to use in the future can be invested more aggressively. So you're earning 7 or 10 years. Well, let's say you earn, 7 or 10%.
Yep.
It's a lot more exciting to see that money double over 7.2 years at a 10% growth rate.
So, Erica, I spoke to first understanding why, right? In terms of what matters
Right.
to us and why this is important. And then step 2 is understanding where we are today, even at a young age.
Right.
So can you walk through these financial statements with us?
Sure. This first column here, maybe it's familiar to you, but it's essentially your net worth statement. This is your balance sheet. Assets, what you own, your checking account, if you have a Robinhood account, your other investment accounts, maybe you have a nice collection of sneakers. That is all part of your assets. And then you take away your liabilities, so what you owe. Maybe it's a student loans, maybe it's credit card debt. We'll talk about that later. But you deduct that from what you own, then you end up with your net worth. And we like to do this for our clients.
Oh, yeah.
You can start simple, just tally up what you own, what you owe, and then keep track of your net worth. It'll be fun to see it grow over time.
And ideally, it's positive.
It's positive.
That's the goal.
Right.
And you can, again, if you have a pen and paper, you can even start a basic version of this right now. We start our balance sheets at the top with bank accounts.
Yeah, checking,
Checking.
savings accounts.
Yep.
Yeah.
If there's a high yield account.
High-
You have retirement accounts already. Those are all part
some of
your
you that
assets.
some of you that may be out of college may already have Roth IRA or something like that, which we'll dive into, but that's an asset.
Correct.
Yeah. And I like to say here, like, net worth doesn't equal your self-worth. So doing this exercise can sometimes feel a little bit jarring. Especially I have some clients that started off with a negative net worth because of all their student loans. They went to vet school. They were becoming a doctor. They took on big debt in order to get into the career that they wanted to get into. So don't feel discouraged if it is a negative number. It doesn't mean anything about you personally, but it's so great to just have this information in front of you and be able to check on it periodically so that we make improvements. The first step is just seeing where you're at.
Yeah, it's habit building, understanding, having these skills as a part of what we do at an early age is tremendously powerful.
It's almost a reality check. It's good to know where you stand periodically.
Yeah.
The second column is your income statement. So you work, you earn money, and then you spend for your lifestyle, whether it be rent, when you go out to eat, travel expenses, whatever that may be. After you deduct all of that expenses, what is left in your bank account? That's your savings. This savings could be used for, as Spencer has showed in an earlier slide, it can go towards your emergency savings, or once you've got that figured out, you can start investing from the savings that is left every month or every year. And in the third column, not a lot of people talk about this because they have the money piece, but this ties into the why. Why are we doing all this? What does that get you at the end of the day? Do you feel fulfilled?
Yeah.
Hopefully you do.
I think that it's important that if you've taken the time to think through the why and what matters, I really do believe this is important, where it will guide us that our spending is purposeful.
Right, right.
We're spending money in a way that aligns with our values and what we want to create in our life. And hopefully it helps us say no to those moments when we're not spending for the right reasons.
Agreed.
Yeah.
We have a question that came in that says, besides loans, what else would you consider a liability?
It's a great question. So credit card debt. So it doesn't necessarily have to be debt, but a credit card. If you have a balance on your credit card, that would be a liability. Probably
Down the road, when you buy a house, the mortgage against that house, that is debt.
Yep. Buying a car.
buying a car,
Auto
you have an
loans.
auto loan, that would be considered a debt.
Yep.
If
If you owe your parents some
Yeah,
money,
maybe.
they want-
your parents.
They're expecting
something,
you to
it
pay
could
them
be
back?
debt.
on the liability side.
Any other sort of, this is probably a common among your age demographic, but there's a lot of payment plans out there these days where really
Buy now.
anecdotal, buy now, pay later, like,
Affirm and
affirm. Let's say you buy a Coachella ticket and you can buy it now, you're buying it, but you have a payment plan. That's still a debt that you owe.
Yeah.
So
Really good one.
that would be considered a liability. And there's a lot more companies kind of putting that out there when you go on just to buy clothes on, Nordstrom or wherever online. Those Klarna, Affirm, those are still a debt or a liability.
Yep.
So anyway.
Great question. Keep them coming. All right. Budgeting, 50-30-20 rule. And before, Lindsay, you jump in here, one of the things I want you to hit upon is the phrase "pay yourself first," and how important that is. Maybe you could incorporate that into budgeting.
So when he says pay yourself first, he means like setting aside savings for yourself. So if you start in the top left,
it's almost, sorry to jump in, but it's almost like we're moving these savings above the expenses.
Yeah.
Where I think too often money will come in and they spend it and then they see what's left over.
Right.
What's left.
And if there's money left over, they save it.
Yeah.
And it's the idea of flipping it.
Yeah. And
right?
There's a few things that can help with that. We'll touch on it later, but for those of you who might already be working, retirement accounts. So if you have a 401k at work, setting some dollars aside there, that's savings. Now, you may not think that it's for you, but it is. I mean, it's a line item. That money is going out into a retirement account, but that's yours. So there's that. Or let's say you get a paycheck for $100 and you just put $10 in your savings account immediately before you even see the rest of it. That's savings for you. And then everything else kind of falls into these categories. You can see that 50% of this is needs. Now, you don't look at this and say, oh, I got to make sure that 50% goes to my needs and 30, this is kind of just a rule of thumb. But, going back to the income and expenses, what are your expenses? This is kind of a fun exercise you can do with yourself is, what is your rent? What are you spending on food, utilities? Again, if you're living on your own, maybe you're paying for internet, maybe you're paying for electricity and water and trash, like insurance, your health insurance sometimes is already deducted, but those are what we call needs. And then transportation, it's kind of like what goes there, your car payment or your gas. But then if you have Uber and Lyft, kind of goes to the wants. But, there's some laughing here, but the idea is you make sure that, as you get a paycheck or as money comes in, that you're being mindful about where it's going. So paying yourself first, aka saving a little bit or paying off that, paying your monthly car payment or student loan payment, one. The rest, you make sure you're covering your basic needs, and then, that 30% that's left, if it's left, then maybe you can go and, have fun. And
What I find helpful is that I have an automatic savings set. So every time I get paid, that a bit of my money goes out and I don't have to think about it and it's just going. So that's me paying myself first. And then everything else goes to, what I need and then what I want. So I think that taking it out of, I have to think about this really helps.
Yeah. Definitely.
In that sense.
Some quick recommendations here?
Yeah, if you feel motivated after this, yes, we have clients that like to use a pad of paper and write this all down, or they use an Excel spreadsheet. But nowadays, everyone's on their phones or their laptops, and there's a lot of different programs that you can use. Some of them are free; they have free trials. I personally like Monarch, but it does end up costing money. But just to kind of give yourself that freedom of looking at your expenses on a day-to-day basis. If it sounds overwhelming, some of these apps can kind of do it for you. You link your bank, you link your credit card, boom, it'll give you this data and help you kind of realize where your dollars are going.
And at this point in your life where your cash flow statement, the income and expense statement is probably a little bit simpler. When I was younger, pen and paper, Excel spreadsheet, the banks have improved as well. I bank with Bank of America, and their budgeting tools are they're included and free and helpful. So make sure you're doing something.
Yeah. Even if you just look at your bank statement at the end of the year, take a last year's statement, there's some cool data you can pull off of that just to see where the dollars go.
Right. And that is a good habit regardless.
Yes.
You'll see some, subscriptions you may have signed up for in the past and forgotten about it. It will show up on your credit card statement. So it's a good habit to also just review it regardless, whether you're for budgeting, tracking, but
I know Rocket Money's on TikTok a lot. All these people post it, tell you to cancel those subscriptions. So
well, the subscription, we're in a world where every company feels like every company wants us to sign up and subscribe, and all of a sudden there's an automatic monthly, and you gotta keep an eye on that stuff.
You have to, and like a lot of going back to free trials, you gotta make sure you cancel those free trials eventually if you don't end up using it. Because even if it's $10 a month or whatever, it adds up if you have 10 of these at once. So
you know what I actually would throw up here is just a calendar app. So that's what I do when I sign up for those free subscriptions. I will put the date down in my calendar and know, hey, this is the day to cancel it, because that'll keep you on track.
Yeah.
Smart.
Yeah.
Chloe, I'm gonna get this over to you here to lead this section, and can you take some time to educate us about what is a credit score? How do we learn about our credit score? How is it determined?
Before everybody's eyes glaze over, I want to say you can potentially save hundreds and hundreds of thousands of dollars in your future if you get that credit score up. And it's true, let that sink in, because let's say you're applying for a mortgage or an auto loan. If you get a couple percentages higher because you have a low credit score, so let's say they lend you the loan at 8% instead of 3% or 4%, that's thousands of dollars month after month, year after year that you're paying in interest to the bank instead of keeping in your pocket. So with that, this is why this section is incredibly important. Your credit is like your adult GPA. It's a track record of how you borrow and repay your money. So there's some common myths that I hear about credit quite often, like carrying a balance on your credit card is good for your credit. Have you guys heard that one too?
Yes.
And it's not. The only thing that does is you pay interest to the bank. So you want to be paying off your credit cards in full every single month.
But Chloe, it's good to use the credit card responsibly.
Yes.
And you do want to use it to show that you can responsibly pay it back. But your point is make sure you pay off that balance in full each month.
Yep. And that's where I'll go back to the calendar app. Make sure that you know when that payment is due, so you're paying it on time. And to Erica and Lindsay's point earlier, having set up auto pay is great. So another common myth I hear is that your debit card builds credit, and that's not true either, because your debit card is linked to your checkings account. There's money in there, so you're not borrowing from the bank like you do a credit card. So you want to be using. Go ahead, Lindsay.
Yeah, A quick anecdote there too is some banks do now provide like credit builder cards. So it's a credit card, but like a debit card, and it helps you build your credit. So, that might be something you may already have, or you can, if you're under 18, you may have to talk to a parent about. But it's a good point because I still hear people in my age group say, oh yeah, my debit card builds my credit. It doesn't.
Yeah, that's a great point, Linz. The last myth I'll say here is I don't have debt, so I must have good credit. And that's not true either. So if you've never borrowed, you don't have a credit history. The banks care about credit because it's a way they can see that you've been consistently paying off your debts. And it just shows them, hey, we can trust this person to pay back the loan that we'll give them.
Yeah.
So credit isn't about being wealthy, it's about being consistent. On the right-hand side of this screen, it'll show you guys how your credit score is made up of. And your credit, it ranges from 300 to 850. 850 is like excellent. It's perfect. So your payment history makes up 35% of your credit score. So that's just asking, are you paying your bills on time? Even if you miss one payment, it could potentially drop your score 60 to 100 points and stay on your record for up to 7 years. So that's why it's really, really important to be paying yourself on time.
An anecdote on that, just quickly. When I was in college, I went to Macy's and I bought a watch and I opened their credit card because they told me it would save me 20%. And where does the bill go? It got sent to my parents' address and I was late. One payment. Stayed on my report for 7 years. All to save 20% off a watch. Just to say, Chloe, it's great that you're bringing this up because it really can stay on your report for 7 years, and that was one payment. So if you're shopping or this or that, and make sure you know where that bill is going, or you set up auto pay so that doesn't happen to you.
That's a really good story, Lindsay.
It's a true story.
Yeah.
The next story for Chi-Chi.
Yeah.
Not good for you.
Yeah, not for you personally.
Yeah. And my score is now rehabbed. It's great now, but that happens.
So the next section is amount owed, which is 30% of your credit. So that means how much of the available credit are you using? So you'll see on your credit cards, you have a credit limit. And for easy math, let's say that your Bank of America credit card, your credit limit is $1,000. If you are spending $800 a month on that credit card, even if you're paying it off in full, you're utilizing 80% of your credit limit. That's too high. We want to keep it under 30%. So that would be $300 or less on that credit card. One of the easy solutions here is on a monthly basis, you can call up your bank and ask for a credit limit increase. I do this all the time. You can even request it through the app. If you get a raise at your company, you can put your new annual income in there and they'll give you a credit limit increase. So we want to keep that utilization rate to less than 30%. The next section here is credit history. So this is your track record again. The banks want to see how long you've had a good track record for. So now Lindsay is past that 7-year little hiccup and she has a perfect track record. And so she'll get a lower interest rate on any auto loan or mortgage that she applies to in the future.
Chloe,
go ahead.
I just want to touch upon the comment there in credit history. Don't close old cards. A little bit more nuanced than that.
Agreed.
Right? If a credit card has an annual payment and you don't want to use it, what do you think? I mean, should that card be closed? What experience do we have here?
I have an experience on that. Perfect segue. I opened a Disney card because going to Disneyland nowadays is so expensive. I opened one to get some credits off of my bill. but I did not want to pay the annual fee on that. So I called Chase and said, can I close this card? And I know it will have an effect on my credit a little bit, but they told me, do you want to move your credit limit to your other Chase card? And I said, yes, go for it. So I've done the increased my credit limit, but I also closed that credit card that had an annual fee.
Yeah.
So far I haven't seen anything on my credit about what I did, but that could be an option.
And on this topic, one thing that my mom did for me was she added me as a user to her card. Now, I'm not saying this is everyone's situation. I didn't even use the card, but because I was tied to it, I have a 40-year credit history. Now, I'm younger than 40, so there are ways, there could be some creative ways to get a longer history as well. Some of you may not be 18, so you may not even be eligible for a credit card, but there are some, creative ways to get that longer history.
There's a caveat to that. That only works if your parents have good.
Well, true.
Yes.
You're right. You're right.
As long as they're checking all these boxes, then it can help you.
Yeah.
It could backfire. It could backfire.
Lindsay's
Your parents were
point,
responsible.
yeah, to Lindsay's point, being an authorized user is what she's talking about. And it's the best way if you have a friend or family member who has really amazing credit, it's the best way to get their credit on your record. So you basically, if you have a friend or family member who has excellent credit history, you can have them sign you up as an authorized user on their credit card, and they'll get a credit card in the mail with your name on it. They can clip it up and throw it in the trash can, never give it to you. But so for free, you'll have their credit history now, which is amazing.
We got a question.
Yes.
Should we ask our parents about adding us to their credit cards? I realize I don't want to start a rabbit hole here of you guys all asking your parents to add them. It depends. I think that it goes both ways. If you are added as a user to someone, you also have to be responsible because you don't want your habits to reflect poorly on the authorized user's card. So it could be worth a discussion. But I don't want to say we're preaching, go add yourselves to your parents' credit cards. It's something to explore.
That's one way.
It's just one way that you can
credit
build
history.
Yeah.
But there are also other
yeah.
And then I'll just zoom through these last two. So 10% is new credit. So that means applying for new credit cards, applying for a loan. It drops your score if you do that, if you do a hard inquiry. And the reason why it drops your score if you do a hard inquiry is because it signals like, hey, maybe there's some financial hardship for this person if you're applying for a bunch of credit cards. But one of the myths that I hear is pulling your own credit affects your credit score, and it doesn't, because that's a soft inquiry. And then lastly, your credit mix. So 10% of this is about the variety of different loans and credit cards that you have. So having different types of credit can help your credit score.
I heard that paying bills helps our credit, like utility bills. And do we know about, like, if you have
they can send you to collections if you don't pay, but
so it doesn't necessarily help, but it could hurt.
It could hurt, yeah.
Right, like with
That's my understanding.
your cell phone bill, your utility bill, yeah.
And to the hard and soft point, like I said before, with those buy now, pay later, a lot of those Klarna or Affirm that you might see, those are what are considered soft inquiries. So they don't affect your credit, but there's still a liability on your balance sheet. So you don't want to just not pay them because they're not pulling your credit. You have to be mindful of that too. So it's a really good point where Chloe's saying have that mix of credit And a hard inquiry is, you know, a new credit card, a mortgage, an auto loan,
Yep.
where they're pulling your number.
I think on the next slide, we talk a little bit about the different
Yep.
ways that you can build your credit. And Spencer, what I heard you talking about, is there a way to get credit for paying utilities or subscriptions that don't come off of your credit card, even rent? There's this program that's free called Experian Boost, and you can link your bank account to Experian, and they see what your recurring expenses are that aren't getting included in your credit score. And it's a really easy way to start getting credit for rent, utilities, those types of things.
Very good.
But these are all things I believe we already touched on, just like a summary of the things.
Perfect. And we did hit upon these earlier. This is addressing the debt liability side of the balance sheet. And I think the question earlier tackled this. So, gosh, I mean, credit, we could talk about credit for
Credit for a while. Well,
we're gonna pivot.
Yeah. We're gonna pivot to the investing side.
Once you have money that you can set aside and you pay yourself first, and you have dollars that you don't want to spend, where can you put those dollars? And this is an internal chart that we built to walk through those options with you. We can certainly get you a copy of this afterwards. Very first starting point is money that you have at the bank. And you certainly want to make sure that you have the right amount of cash so that you don't fall into debt and use credit when you don't need to. So you have to make sure that you have the right amount in cash, checking, savings, money market. Today, banks are not paying much.
No.
And a good money market is yielding about
3.5%.
About 3.5%. So your day in, day out checking account. Your savings really should be in a high yield savings account or money market, and those dollars should be earning about 3.5% right now. On the left side of this, you'll see the typical range of what this money should be earning for you, 0 to 4% in that cash category. So again, 3.5%. Enhanced cash, maybe for money that you might need in a year or 2 or 3. You can look at CDs from banks and short-term bond funds where we can try to get 4 to 5% on those dollars, still liquid and very safe. As we work our way down this diamond chart, there's a little bit more risk, a little bit more volatility. Bonds are in that income and absolute return category. And at your age, candidly, with long-term dollars, you're going to want to focus on the bottom half.
Mm-hmm.
You're just going to get a better return. And you have the time to deal with the ups and downs and the volatility that's natural in the markets and with investing. Bonds could be a good place for money and dollars that you might need in 3 to 5 years at your
Maybe
age.
you're buying a car, or maybe not a house yet, but a car or a big trip in the next couple of years.
And you want it to do better than 3.5%, but you want it safe and you want it available. That's when you look at bonds. A good bond fund should earn you 4 to 6% right now. And technically, on the top half of this chart, you're lending your money. You don't own anything. You're letting the bank borrow your money, and you're letting the government borrow your money. You're letting a corporation borrow your money, and you get paid interest on those dollars. Now, on the bottom half is where you can really build wealth long-term through ownership. This growth and income category is our favorite section. It's owning stocks that pay dividends. So even Apple has a little bit of a dividend.
Yeah.
The most traditional names would be an Exxon, a Chevron, a Coca-Cola,
Coca-Cola,
Procter & Gamble.
Verizon.
So Verizon makes all this money, and they have made the decision to share some of it with you. Maybe address these to see we have some good questions coming in. So Verizon has a dividend. So when you invest into Verizon or Coca-Cola, your return comes from two things. Hopefully, the stock appreciates and there's growth, and there's that dividend. and that cash comes in on a quarterly basis and helps with that return. And you can own stocks directly. You can own them through funds and ETFs. You want to be diversified. So, and the beauty of our industry, it's changed so much.
Yeah.
There are no commissions. You can buy fractional shares. I mean, a young investor more than ever can be diversified with not that many dollars.
Yeah.
If you do want to own individual companies, you can buy fractional shares and start to build a properly diversified portfolio.
An emphasis on the word diversified. Going back to what's happened, what you see on TikTok, and maybe you've heard meme stocks. There's a lot of information out there to buy this one stock or that stock or this crypto. It's not diversification if you're having all your dollars in one stock or investment.
Agreed, Lindsay. You want to be diversified across this whole chart. Now, and I'll go quickly here because I want to address this point. So growth and income can also include real estate. Over time, you could invest into real estate through funds and ETFs. Maybe one day in the future, you own an apartment building and it's rented out. So there's hopefully growth and appreciation from the real estate being worth more, and there's income from receiving rent. Growth investments have a little bit more volatility, a little bit more risk. Think of Tesla, Google, NVIDIA, AMD, these big names where there's a ton of growth potential. But Elon Musk does not share any of his cash with you. All the cash that Tesla makes, all the cash that SpaceX is making, he keeps every dollar and he reinvests it into the business. And you are betting on Elon Musk to successfully grow Tesla, grow SpaceX. You're betting on Mark Zuckerberg to grow Meta, Facebook, and Instagram. And the return is going to come from that company being worth more in the future. There's no dividend or a very small dividend from growth names, but you can get a lot of growth if you invest at the right time. The challenging part is stocks can become very hot, and oftentimes we see investors want what's hot, and which leads to buying high when we've all heard or should have heard buy low, sell high. And so just be careful with growth stocks and try to be disciplined in building out that part of your investment plan.
And this is where we can help.
Yes.
If you're really interested in doing this and ready to take on the next level, we are here to help you.
Yeah.
We did get a question about going to the top of the chart on high yield savings accounts. It's a good question. There's a lot of them out there. We first recommend going to your bank. So if you bank at Bank of America or Wells Fargo or Chase, they may offer one. But if it's, if the rate's not great, then you can also go to like American Express has a high yield savings. Goldman Sachs has Marcus by Goldman Sachs, a high yield savings.
We have a good one. SoFi is good. I think their high yield savings is 3.8. And if you open a checking account with them too, I think it pays 1% as well.
Eric and I are pros at finding random deals with the banks. So if there's a lot of introductory offers, use those to your advantage.
Aggressive investments at the bottom can potentially have the biggest return, but they are certainly going to have the most risk, the most volatility. Think timing the market, trying to jump in and out. It's small companies, brand new IPO, initial public offerings. It's emerging markets and international. It's crypto. It's meme stocks. And listen, we're not opposed to having some dollars in aggressive investments, but to your point, you're not diversified if you have a meme stock and Bitcoin and some brand new small IPO stock. You are, all of those are in the aggressive category.
Yeah.
So you need to have some investments that pay dividends. You need to own some big growth names, and it's okay to have some aggressive investments in the right allocation. That's that 0 to 15% of a portfolio. That's our guidelines for what dollars should be in that aggressive, can potentially be in that aggressive category. And we got a great question about how to manage investments. If you socially responsible, politically opposed to a certain company. The two quick answers would be pick individual names that resonate with you. So you, again, can own individual companies in very small amounts. Two, the industry certainly has many socially responsible investment choices, and you or with an advisor can help you find the strategies that remove and do not have those companies that you do not want to be invested in.
Yeah, going back to the chart in the beginning about, we have income and expenses and assets and liabilities, and then, the regrets chart, but you want to be fulfilled with what you're invested in. And if, being socially responsible, or you'll see the letters ESG, employees, what is it? Environmental, social government. Sorry about that. You'll see that if that's in the name of an exchange traded fund, or a mutual fund, or that means that there's a lot of certain things like gas and oil is stripped from those investments. So you want to know what you own, and you want to be comfortable with what you own. So that's a great question, and
you want to feel good about what you own.
Yep.
Yeah. The next slide's a really good segue. So now that we've kind of showed you how you can invest, it's, well, where do you invest? And there's a lot of different account types out there. Some of them you may have heard of, some of them you may not have, but this is a nice high level chart of, what types that you can invest in. Mm-hmm. So high level, Roth IRA.
One of our favorites for young investors.
There's a star. The beauty of a Roth IRA, and we'll get to taxes if we have time at the end, but is that the dollars grow tax-free. And at your age, you're probably whether you're employed or not, you're probably in a lower income bracket, which makes you eligible for a Roth IRA.
Right.
So
yeah,
we put some of the limits here. And again, in the interest of time, we don't want to go through every single line item here, but a Roth IRA is great. You put dollars in, they grow tax-free, and you still have time.
Well, the big thing, with a Roth, to your point, most folks at a younger age are in a lower tax bracket, so they don't necessarily need that deduction. So there's no tax deduction on the way in, but they put dollars in, and it's one of the few places, literally, where you'll make money, the government won't touch it, because those dollars will never get taxed again. And there will come a point for all of you where you'll probably make too much money, and you won't be able to use a Roth.
Right.
So use it now.
Correct. Thank you, Spencer. The second one is a 401k bucket, which is later on we'll try to talk more about the details of the 401k. It's essentially the same thing, but it's offered through your employer. So your employer will let you have the ability to put money aside from your paycheck, put money into 401k. For this one, the 401k could come in pre-tax or after tax. So after tax is essentially like a Roth IRA, but with a much higher limit, allowing you to put more money into it. Pre-tax 401k works the opposite way. You get the tax deduction now, but the money that you put into the 401k bucket, it grows tax deferred. So it's not tax free, it's tax deferred. By the time you take the money out of that 401k bucket, when you're retired, all of it will be taxable to you. And the idea on that is, hopefully when you're retired, you are back to the lower tax bracket where you're not working anymore.
Yep.
So.
Good. And let's go through these let's go through these quickly, and then I want to get to taxes.
Yeah. Traditional IRA, same limit as a Roth IRA. However, depending on, let's say your company doesn't offer you a 401k. Then a traditional IRA is another way to get that tax deduction Erica mentioned. And then, yes, those dollars will go. We'll get taxed eventually, but it's a nice way to get a deduction if you may not have a 401k or 403b through work. A brokerage account.
Real quick, sorry to interrupt. You cannot have a Roth, you cannot do both, the Roth IRA and the traditional IRA at the same time.
Correct.
That 7,000 limit is one or the other, or I guess you could split it. That's one limit.
Yep.
brokerage account, that's a normal investment account. If you just open an account at Fidelity or Schwab or whatever in your name, non-retirement, that's a brokerage account. There's no limits. And that's kind of a good place to start if the other two seem a little overwhelming on the tax front.
Well, the taxes on this is the money that you put in, no deduction, of course, but if you made money on that investment, as we've mentioned before, you receive a dividend from one of your investments. All of that will be taxable to you.
Then some of you, if you are employed, your job may offer what's called a health savings account. You're only eligible if you're in a certain type of insurance plan called a high deductible plan. I assume if you're working, you might be in that type of plan. They're great because there's 3 tax advantages: deduction in, gross, tax deferred, and comes out free, tax free.
If you use it for qualified medical expense.
But again, it's, has some rules around what you can use the dollars for. And a 529 doesn't really affect you guys, just so you know. There are education savings accounts. Some of you may benefit from one, or maybe it's something you eventually want to set up for your kids, but they're just good to know about. They're for qualified education expenses.
We've talked about 401k. The K doesn't stand for anything. Quite literally, it's a section of a tax code. It's the government incentivizing individuals to put money into their retirement. And in exchange, you're going to receive some tax breaks. So either, as we've mentioned before, depending on what type of 401k you use, if it's pre-tax, you get the tax break now. Simple example, you make $10,000, you put 10% into it. The government recognizes that you only made $9,000 and will tax you on the $9,000. That $1,000 goes into the 401k bucket where you invested, it makes money. You don't pay taxes on it quite yet, but when it's time to take the money out, all of that will be taxable to you.
And that's where we go to paying yourself, contributing to a 401k. Right. That's paying yourself for money you'll use in the future.
And we say that because usually a 401k, you don't even see that hit your bank account. It's the company withholds it from you and then puts it in your 401k account for you. So that's a good way to set it and forget it.
Yeah.
Flip side, again, Roth, another good, we like Roth 401ks. You don't get a tax break. So if you put 10% from a $10,000 paycheck, you get taxed on the $10,000, but $1,000 never gets taxed again, which is great.
The next slide kind of just shows you the impact on a paycheck. We're kind of rushing through it here, but Erica kind of explained this here.
Right. So however much you put into your 401k will affect, of course, your net paycheck. This is just an example of what it could look like. Again, pre-tax, the federal taxes that you pay will be a little bit less, and then your net paycheck will also be a little bit less. If it's a Roth, it's a simple dollar amount. If you put $50 per paycheck into a Roth, your current paycheck will be reduced by exactly that amount of money that you put into a Roth.
Good.
Ooh.
Yeah, this is a
fun visual of where Uncle Sam or where the taxes are encountered when you're putting money into a regular 401k, a Roth 401k, or you don't participate in a 401k, you just invest it outside. I do want to point out, if your company is offering a match, which means at a certain point when you're participating in a 401k, they will offer to match it for you. Don't say no to that. Yeah. That's equivalent to saying no to a bonus.
Free money.
Free money. So at the very least, I know it's hard to think about, my paycheck, I'm tight, it's tight, but if they're offering a match, try your best to contribute
like they might say 4% match. You could just put 4% free money to you.
Exactly. And that is going to you.
Got to do the match.
Yeah.
You got to do the match.
Got to do the match.
The match, though, is always pre-tax.
Yeah.
So just FYI. So even if you're doing it. We save the best for last. It's coming up. taxes. Everyone has to pay their taxes. Good rule of thumb, the deadline to file is April 15th every year. Well, sometimes it changes, but April 15th, if you are earning a wage, you're more likely to have the responsibility to file your taxes.
Yeah.
If you make, I think the deduction is 15,000. If you make that amount, there may not be a filing requirement for you, but a good rule of thumb is if any taxes are withheld from your paycheck and you want to be able to get a refund, you must file.
The next slide is important too, because I've anecdotally, again, had a few clients who didn't know they had to file taxes. So if you do get a W-2 from your employer, or even if you get a 1099, if maybe you're not at a job that gives a W-2, make sure you at least read it, make sure you understand it, and even if you have a bank account or you have an investment account already, you might still get a 1099 and you need to address it because the IRS will come back one day and ask you where their money is. So,
and TurboTax is a great resource too here. So just when you get these forms in the mail, don't just discard them. Keep them and take photos of them on your phone to upload to your TurboTax app, and they'll lead you in the right direction. They should lead you in the right direction on which ones to upload.
Now,
All right.
yeah, we went over a lot today. So
What are our action items, team? So what do we think that our listeners can tackle, should look into right away?
hopefully we motivated you to do a few.
You should know your credit score.
Yeah.
If we were to ask you right now, what is your credit score? You should figure out that answer over the weekend. If you have too much money sitting in a checking account, make sure you get some of it into a high yield savings. Mm-hmm. Start using some sort of budgeting tool.
Whether it's a notepad where you keep track or one of these apps. Calculate
your net worth. And then over the coming weeks, start to save automatically or save a little bit more automatically. If you have a job with a 401k, get enrolled.
Enroll, log in, try to get the match. If there's a 4% match, make sure that's what you're contributing, or at least up to that if your budget allows.
Open a Roth, map out your income, try to max out that Roth, and start investing.
If the compounding interest charts in the beginning of this, if you remember that from an hour ago, showed you anything, starting now is in your power. I mean, you have the time. So really just hopefully this motivates you to just do a little bit of something now. Because the future you will thank you.
What a great way to end. I feel like that was really productive. Thank you, Chloe, Erica, and Lindsay, for all of your input. Just an incredible amount of knowledge, and thank you for sharing it with everybody. And we hope you found it worthwhile. We're here. Please reach out with any questions, and we'd love to help out. Have a great day.